It takes a family practice physician 3 years to finish their residency.
Right? 3 years.
Yeah, that is 3 years of specialized intensive training, and then they're out there making literal life or death decisions for patients.
Exactly.
Yet to walk into a house, evaluate the height of a handrail, or document some chipped paint on a baseboard, the Department of Veterans Affairs requires an appraiser to have up to 5 years of apprenticeship experience.
5 years just to look at paint.
I mean, that contrast between a 3-year medical residency and a 5-year apprenticeship just to appraise a single-family home is, frankly, the perfect entry point for what we are analyzing today. But before we get into the details, please take a second to like and subscribe to the show.
Yes, please do.
So, today we are looking directly at a specific committee hearing that took place on March 26, 2026, within the House Veterans Affairs Subcommittee on Economic Opportunity. The hearing is titled Kitchen Table Issues: Lowering Costs for Veteran Families Through the VA Home Loan Program.
Right, and our objective here is to really examine the original source material from this hearing. We're looking at the video transcript, plus the written testimonies submitted by government officials and industry leaders.
And what exactly is the mission of this analysis?
Well, we want to look at the current state of the VA Home Loan Program to understand the key debates, who is directly affected, and what the long-term consequences are.
Got it.
The overarching motivation behind this committee hearing is to find actionable ways to keep housing affordable for veterans, modernize the VA's processes to match conventional loans, and really prevent a looming wave of foreclosures.
Which is incredibly important.
Yeah, because when you analyze these documents, a clear paradox emerges. The mechanisms originally designed to protect veterans in the housing market are, in some cases, the very things boxing them out of it.
And that paradox is so critical right now. I mean, the VA Home Loan Program, right alongside the GI Bill, is widely considered one of the most successful government programs in U.S. history.
Oh, absolutely.
Since the 1940s, it has guaranteed over 29 million loans, totaling more than $4 trillion. It is basically the primary engine of generational wealth for millions of families.
It really is.
But in today's housing market, you have a national shortage of around 5 million homes. Inventory is incredibly low, costs are historically high, and veterans are actively being squeezed out of the market by all this administrative friction.
Which brings us to the first major hurdle discussed in the hearing, and that's the barrier to entry for just purchasing a home.
Right, just getting your foot in the door.
Exactly. In a market where there are, 5 million fewer homes than buyers, the power dynamic sits entirely with the seller.
Sellers hold all cards.
Right. And sellers are looking for the path of least resistance. If a seller receives a conventional offer and a VA offer side by side, testimonies indicate they are increasingly rejecting the VA buyer.
Man, that is frustrating. Why is that happening?
The debate centers heavily on minimum property requirements, or MPRs. VA loans require specific property conditions that conventional loans simply do not mandate prior to closing.
Okay, so if you are looking at a house and it has, peeling paint on the garage, or it lacks a specific type of handrail on the back steps, a conventional buyer can just buy the house and fix it themselves the following weekend.
Exactly. The transaction closes smoothly.
But a VA buyer cannot legally close on that home until those specific conditions are met by the seller beforehand.
Right. The seller has to do the work.
So essentially, the VA is trying to prevent a veteran from buying a money pit. But in a highly competitive market, sellers are just looking at that red tape and choosing the easier conventional offer instead.
That is exactly the issue. And the National Association of Realtors argued heavily during the hearing for aligning VA standards with Fannie Mae and Freddie Mac to remove this friction.
Makes sense from their perspective.
Yeah, their stance is that veterans are losing out on viable homes simply because sellers refuse to deal with the potential delays of a VA appraisal.
But I imagine the VA pushed back on that.
They did. They provided strong pushback against completely stripping these requirements. Their argument is that removing all MPRs could expose veterans to unsafe living conditions or, immediately saddle them with costly structural repairs.
Right after they have wiped out their savings to cover the down payment and move-in costs.
Exactly. But the VA is taking intermediate action. They are updating Chapter 12 of their lender's handbook to remove several cosmetic requirements, which is an attempt to strike a better balance between protection and competitiveness.
And then you have the bottleneck of the appraisers themselves, which goes right back to that physician analogy from the hearing.
Oh yeah, the 5-year requirement.
Yeah, when you demand up to 5 years of experience for an appraiser to be certified by the VA, while the Federal Housing Administration only requires 12 to 18 months of training, you just create a massive logistical shortage.
You really do.
The hearing noted there are 436 counties across 31 states that do not have enough certified appraisers to meet the local demand.
That is a huge chunk of the country.
It is. If you are a veteran in one of those counties, your closing timeline is extended by weeks, your fees go up, and again, the seller is more likely to just walk away.
Right, and these debates over purchasing hurdles also extend directly into the financials, specifically the mechanics of seller concessions.
Oh, this was a big point of contention, right?
Yeah, it was. Currently, the VA caps the amount a seller can contribute to a buyer's closing costs at 4% of the total loan value.
Okay, 4%.
But the Federal Housing Administration and the USDA allow up to 6%. Industry experts at the hearing argued that the VA should match that 6% to help cash-strapped veterans cover immediate closing costs.
I mean, if you are a buyer looking at high interest rates, having the seller cover 6% of your closing costs sounds highly appealing on paper.
It definitely sounds great.
Let's quickly break down what a seller concession actually is for anyone who hasn't navigated a mortgage recently. A concession is basically when the seller agrees to pay for certain costs on behalf of the buyer, like appraisal fees, title insurance, or property taxes, just to help the deal go through.
Right. It lowers the out-of-pocket cash the buyer needs at closing.
But the VA warns of a long-term financial impact here that contradicts the whole goal of affordability.
Yeah, they have a major concern with this.
If the seller is giving you $10,000 for closing costs to hit that 6% mark, they usually don't just absorb that loss out of the goodness of their heart. They just raise the asking price of the house by $10,000 to offset their concession.
Exactly. And that mechanism is the core of the VA's resistance, because the veteran is now financing that artificially higher base price over a 30-year mortgage.
Oh, so they are paying interest on it.
Yes, they're paying compound interest on that extra $10,000 for 3 decades. They end up paying significantly more over the life of the loan.
That is a harsh reality.
The VA argues that increasing the concession cap to 6% masks the immediate affordability issue while drastically inflating the total debt burden placed on the veteran over time.
Okay, so we have outlined the immense friction of actually getting the keys to the house. But the committee didn't stop there, because securing the house doesn't really matter if you cannot keep it when life takes an unexpected turn.
No, it doesn't.
Let's look at the safety nets for homeowners facing financial hardship. This is the second major area of focus, the foreclosure cliff. Last May, the VA ended the Veterans Affairs Servicing Purchase Program, or VASP.
Right.
That decision left a massive gap in foreclosure prevention. Congress responded by passing House Resolution 1815, which created a permanent partial claim program to help veterans stay in their homes.
We really need to define what a partial claim entails here.
Please do.
A partial claim is a loss mitigation mechanism where the past due mortgage payments are moved to the end of the loan as a subordinate lien.
Okay, subordinate lien meaning what exactly?
To explain that simply, think of it as taking the missed payments, putting them in a separate financial box, and placing that box at the very end of your mortgage timeline.
Ah, okay.
It sits there as a silent second mortgage, collecting 0 interest until you either pay off the house entirely or sell it.
That sounds like a solid safety net.
It is, because it allows the homeowner to resume their normal pre-hardship monthly mortgage payments without having to come up with a massive lump sum of cash to catch up.
The problem, though, is the rollout for this new permanent partial claim program is not happening until June 2026.
Right, there's a huge delay.
The gap between the end of VASP and the launch of the partial claim program has left many veterans highly vulnerable. And this surfaced a very sharp debate over the VA's proposed waterfall plan for loss mitigation.
Yeah, the waterfall plan was heavily scrutinized.
A waterfall is basically the step-by-step ladder of options a mortgage servicer must follow when trying to help a borrower who has defaulted. According to testimony from the National Consumer Law Center, the VA's draft plan requires a homeowner to accept up to a 15% increase in their monthly payment on a 30-year modification before they are even allowed to access that payment-stabilizing partial claim.
And the financial impact of that structure is severe.
I can imagine.
There are currently 90,000 seriously delinquent VA borrowers. Under this proposed waterfall, an estimated 30,000 of them would face this payment increase.
That is a lot of families.
Right. If your mortgage is $2,000 a month, a 15% increase adds $300 to your monthly bill. The VA structured the draft this way to try and limit extending the total term of a loan or increasing the aggregate amount due to the government over time.
But the logic seems entirely backward there.
It really does.
If a veteran is already defaulting because they lost a job, experienced a medical emergency, or had a drastic reduction in household income, forcing a $300 per month payment increase on them does not solve the delinquency.
No, it makes it worse.
It is literally like telling someone they can use a life raft, but only if they agree to carry a 50-pound dumbbell on board with them. The very thing you are offering to save them is mathematically engineering their sinking.
That is a great way to put it. And historically, payment increasing modifications lead to drastically higher redefault rates across the entire housing sector.
Not surprising at all.
When a servicer forces a higher payment on someone already experiencing financial distress, they're often just delaying the inevitable foreclosure by a few months.
Wait, if we look at the data submitted to the committee by Auction.com regarding those eventual foreclosures, the numbers present a massive disparity.
Yes, the Auction.com data was eye-opening.
When VA-guaranteed loans go into foreclosure, 75% of those properties end up as VA-owned real estate. The VA essentially fails to sell them to third parties and has to take the title to the property.
75% is huge.
It is. For comparison, less than half of foreclosed properties backed by HUD, Fannie Mae, or Freddie Mac end up as government-owned real estate.
Right.
If conventional properties are successfully selling at auction, but VA homes are not, is the VA just pricing them completely out of touch with market reality?
That is precisely the mechanism driving that 75% acquisition rate. It comes down to how the VA is legally required to price the homes at a foreclosure auction.
How does that work?
Their statutory requirement often dictates pricing the property based on the outstanding loan balance, plus accumulated foreclosure fees and interest, rather than pricing it based on an independent appraisal of current market value.
Oh, I see.
Yeah. So if a house is severely damaged or the market is cooled, the actual value of the home might be far lower than the debt owed. Third-party buyers look at the inflated price and refuse to bid.
And when third-party buyers do not engage, the VA takes the property by default.
Exactly.
And managing a massive portfolio of foreclosed homes is incredibly expensive for the government.
Extremely expensive. The estimated cost of a home disposition under this current system results in a $72,000 loss to the guarantor per property.
$72,000 per house.
Yes, per property. That covers maintaining the vacant property, paying for security, property taxes, and the eventual administrative costs of resale.
That adds up so fast.
It does. If the VA were to fix this waterfall, utilize market-based pricing at auctions, and expand the use of independent third-party auction platforms for total debt sales, it could save taxpayers billions.
Billions with a B.
Yeah. HUD implemented a similar program called Claims Without Conveyance of Title. That program simply allows HUD to let the house sell at a market rate auction before the government essentially takes the title, avoiding those holding costs entirely.
And did it work?
Yes, that single policy shift saved the FHA insurance fund more than $10 billion.
$10 billion. That brings up a crucial point about the billions of dollars flowing through the system. Beyond the mechanics of buying an individual home and trying to keep it, the hearings surfaced a major conflict about how the VA home loan program's funds are utilized by the broader government.
Yes, the funding debate.
This shifts our focus to House Resolution 6047, the Shari Braley and Eric Edmondson Veterans Benefits Expansion Act of 2025.
Right. And the primary goal of House Resolution 6047 is universally supported across the committee.
Completely.
It aims to expand benefits for disabled veterans and Gold Star families, specifically increasing the dependency and indemnity compensation for surviving spouses.
Which is fantastic.
Absolutely. Providing better financial support for the families of those who sacrificed for the country is a shared priority. The debate is entirely about the mechanism used to fund that expansion.
Right, because to pay for these expanded benefits, the bill proposes using VA loan funding fees.
Yeah, and that is where the friction is.
For anyone unfamiliar, the funding fee is a one-time percentage fee paid by a veteran when they close on a VA home loan. It is designed specifically to keep the housing program running and cover potential loan defaults without relying entirely on general taxpayer money.
Yeah.
So the immediate question raised by industry experts is, why should a veteran who is just trying to buy their first home foot the bill for separate, unrelated disability and dependency benefits?
It is a very valid question. And the Mortgage Bankers Association, along with the National Association of Mortgage Brokers, provided detailed analysis on the financial impact of this cross-funding strategy.
What did the numbers look like?
While using the housing program as a funding mechanism for House Resolution 60047 would affect an estimated 1.88 million disabled veterans who have disability ratings below 70%.
Because veterans above 70% are exempt.
Right. Veterans with a rating above 70% are generally exempt from the funding fee, but those below that threshold are not. The potential financial burden placed specifically on these moderate to lower rating home buyers is estimated at approximately $24.3 billion.
Jeez. So you are taxing the housing program to fund a separate benefit. This directly contradicts the core motivation of the hearing, which is making housing more affordable for veterans.
It really does.
If you increase the fees required to get the loan, you are adding even more friction to the barrier of entry we discussed at the very beginning.
Exactly. But the sources outline a clear alternative proposed by the National Association of Mortgage Brokers to avoid this contradiction.
Okay, what's their solution?
Instead of creating a new tax burden on the housing program, they suggest allowing eligible surviving spouses to simply continue receiving the deceased veteran's 100% service-connected disability compensation rate.
Oh, interesting.
Yeah, because that specific compensation was already authorized, budgeted, and appropriated by the government prior to the veteran's passing. Utilizing it requires no new federal expenditure.
That makes a lot of sense.
It provides the necessary ongoing financial support to the surviving family without placing a $24 billion obstacle in front of veterans trying to access the housing market.
Looking at the full scope of this hearing, the final piece to examine is what happens next. The VA is aiming to officially launch the Permanent Partial Claims Program in June 2026.
Right, that's the target date.
That is the critical deadline for stabilizing the foreclosure cliff. In the meantime, housing advocates are pushing heavily for a full pay forbearance stopgap.
Which would be a huge help right now.
Yeah, this mechanism would allow veterans who have successfully recovered from their temporary financial hardship to resume their normal monthly payments right now and force mortgage servicers to hold off on initiating foreclosures while everyone waits for the new partial claim system to come online.
The VA is also making strides in modernizing its digital systems to remove administrative friction, which is great news.
Definitely.
They noted during the hearing that within a single week of launching a specific enhancement to their mobile app, over 35,000 certificates of eligibility were downloaded directly to veterans' phones.
That is incredible volume for 1 week.
It really points to a massive demand for technological modernization to speed up the pre-approval process and make VA buyers more competitive against conventional offers.
Which leaves us with a final thought for you to explore on your own based on the trajectory of these sources. If the VA home loan program is fundamentally designed as an earned benefit to build generational wealth, how might the integration of artificial intelligence in the real estate market fundamentally change the way veterans navigate these bureaucratic hurdles in the future?
That is a fascinating angle. I mean, if predictive systems can eventually automate manual underwriting, and computer vision can instantly evaluate property conditions via smartphone to satisfy minimum property requirements without a 5-year apprenticeship.
Right, the chipped paint problem.
Exactly. Could the stigma of the slow VA loan disappear entirely? We might be looking at a near future where technology reshapes the entire housing market by removing the friction that currently exists between government safety standards and private market speed.
Absolutely. Thank you for listening to this analysis of the sources. We started today by talking about how it takes 3 years to train a doctor to make life or death decisions, but up to 5 years to train someone to check a house for chipped paint.
Really puts it in perspective.
It does. When you look at the 5 million home shortage, the 90,000 delinquent borrowers, and the billions of dollars at stake, it becomes incredibly clear that untangling that kind of bureaucracy is the only way to ensure the American dream remains accessible to the people who serve to protect it.